Gold continues to shine. In a recent article, Bloomberg revealed that gold's long-term performance surpassed that of Bloomberg's Treasury Total Return Index. Bloomberg noted that a dollar invested in gold in 1973, the year Bloomberg's Treasury Index was introduced, is now worth slightly more than $2,300. That's roughly $170 more than the return of a dollar pegged to the index that year. In the assessment of Bloomberg analysts, gold has jumped ahead of U.S. government debt as a long-term investment. There is, of course, no way to know if this trend will continue. But one of the historical criticisms of gold has been its sometimes understated performance over extended periods in the context of treasuries, which also enjoy a long-standing reputation as a reliable safe haven. Now it appears that relative performance may have changed. What's going on? Let's take a look. First off, bond performance has taken a beating in recent years, principally due to 11 separate interest rate hikes totaling more than 500 basis points in 2022 and 2023. The benchmark 10-year U.S. Treasury note fell in both 2021 and 2022, including a double-digit percentage decline in 2022 that proved to be the worst calendar year performance since 1788. A last-minute rally in the fourth quarter of 2023 is the only reason bonds were spared a third straight year of losses, something that's never happened in our nation's history. As for gold, analysts say it's managed to demonstrate tremendous resilience in the face of those rate increases thanks to a variety of fundamental drivers that include persistent inflation, recession fears, and chronic geopolitical tension. There are growing concerns about expanding U.S. deficits and debt, that very debt which is sold as U.S. Treasuries. Christina Hooper, Chief Global Market Strategist at Invesco, recently suggested the safe haven asset class of choice has become gold rather than treasuries. The bigger theme is just the concern about a lot of debt and concern that the fiscal situation in the United States is unsustainable. According to the CBO's February forecast, the nation's annual budget deficits could average roughly $2 trillion per year over the next decade, and the national debt is on track to increase another 60% to more than $54 trillion. Some analysts say that one reason many central banks have been shedding treasuries, in some cases in favor of gold, is concern about America's increasingly uncertain fiscal situation. In a piece published late last year, the Wall Street Journal reported that overseas private investors and central banks now own roughly 30% less U.S. debt than they did a decade ago. And that trend may be ongoing. China sold off a record $53.3 billion in U.S. Treasuries and agency bonds in the first quarter. Perhaps just as notable, China's central bank was a net buyer of gold for the 18th straight month as of April. In the view of global macro strategist Julian Brigden, we are in a structural bond bear market, adding that, as a hedge asset, gold is taking over. The point of a safe haven asset is to feel safe, regardless of what's happening in the global or national economies or with geopolitical conflicts. It appears many are thinking that the factors that influence treasuries are in question and returning to gold.